Hi again, everybody. The other day I made a video based on a Wall Street Journal headline that read, "Index funds are the new kings of Wall Street." And near the end of that video, I suggested that I would create another video with a deeper dive exploring some of the concepts that there was just no way I could get into in a shorter video like that one. So that's what this video is all about, a little bit of a deeper dive into the investment methodology that I prefer. And so where I left off there was I was saying that I prefer kind of a hybrid approach, taking the best qualities that passive index fund investing has to offer and the best qualities that actively managed investing has to offer, kind of cherry picking those and see if I can put those together and come up with my approach that I think is superior to both. And so on the index side of it, the best qualities by far are the broad diversification that you get in investing in some sort of commercial index that is either an entire country or just big company stocks or small company stocks. Typically hundreds, if not thousands, of stocks in a particular index fund gives you that broad diversification and great risk reduction that comes with having a portfolio that's the opposite of highly concentrated. Also, the best feature of index investing are typically the very low costs because you're not paying high priced for a high price manager or high price management teams to do extensive research and trying to come up with to identify opportunities for buying and selling stocks when and how much and when and so on and so forth. That's the actively managed side of it. I don't believe in that. You'll see I've already posted many videos explaining why I don't believe actively managed works in terms of what their fundamental attempt is to outperform financial markets. I don't think it works. Again, plenty of videos on that. But what am I cherry picking as a best of idea from the actively managed world? The flexibility. Not being constrained as index funds are to march in lockstep to a particular commercial index. Most common would be, say, the S&P 500. An index fund has no choice but to replicate the performance of the S&P 500 as closely as they possibly can. That's what their job is. Now, that necessitates a fair amount of trading when in our example, the S&P 500 is reconstituted, when some companies go in and some come out. An index fund has to sell those leaving and buy those coming in. They really don't have any control over that. That's what their job is. Now, that helps them minimize what they call tracking error, which is a real key concept in index fund investing. But if you look at it, that's why we kind of get into this deeper dive a little bit. If you look at those particular buys and sells that ensure minimal tracking error, they don't do a heck of a lot for us as individual investors. Yes, it minimizes tracking error, but it really adds value to our underlying to the portfolios we hold, the mutual funds we hold that are doing this tracking. Not particularly. Don't get me wrong, index funding is a really wonderful way to go, and I believe far, far better than hitching your wagon to any actively managed funds. But these are a couple things that can be improved upon. So let's flip over to the actively managed side. Well, that's where the idea that I want to take is the flexibility. So how do you combine these two ideas? Well, if you're not trying to slavishly follow a commercial index, like march in lockstep with the S&P 500, the manager or management team is now free to patiently buy and sell securities that make sure broad diversification is accomplished. Don't compromise that. Keep costs down. Don't compromise that. Those are our two big advantages of index fund investing. But the flexibility of not being told exactly what you have to buy and when is real liberating. So, who might these trading partners be? Here's the irony of the whole deal, I guess, is that This type of investment methodology never runs out of trading partners because the actively managed camp will always be identifying what they feel are excellent buying and selling opportunities. Well, you can't buy or sell anything unless you have a trading partner. So the approach that I use, and the particular fund family, now I'm a completely independent advisor, so I can invest my clients' dollars in any mutual fund pretty much that I want to. The fund family that I use right now is called Dimensional Fund Advisors. And what their claim, one of their big claims to fame, is just this exact approach that I'm describing. They will be the first ones to tell you that trying to outperform markets by identifying mispriced securities is a bad idea. No disagreement with me there on them. In fact, I could not. It's the opposite. I couldn't agree more. But Dimensional feels, and I feel as well, that there is value added to us, the individual investor, through a form of smart trading that still accepts the current price of a stock as its fair market value. We're not trying to be smarter than the market and say this is too high or this is too low. No, we're accepting that as fair market value. But remember this active camp that I was talking about? They don't necessarily accept all stock prices as accurate in their estimation at every point in time. They think they're mispriced, and they want to exploit this mispricing by either buying something they feel is the market is mispricing too low, or selling something that they feel the market is pricing too high. They'll sell it and take advantage of that. I don't believe in that. I don't believe you can consistently do that. I think that the market does an incredibly good job of determining what a reasonable price is at any moment in time for any publicly traded security. Doesn't mean people can't and don't make great stock selections all the time, and hindsight being 20/20, say look what I bought, and they brag about it and so on. That's all true. But what we're talking about is a program of investing for the very long term that tries to maximize the skill component of the equation. So let's get back to one of the real key things that Dimensional does that other firms don't in terms of this patient, smart trading. Let's use an example. Stock is trading at $100 a share. The market has determined that $100 a share is the right price. Well, an actively managed firm may have decided that, $100 isn't the right price. They might think $90 is the right price based on their extensive research on the matter. So they're thinking, wow, if I can sell this mispriced security for somewhere around $100 when I think it's only worth $90, we're going to generate $10 worth of value added for our clients. So they need a trading partner. They need somebody who says, okay, I'm willing to buy that at $100 a share. They could flood the market with, because they've decided the whole stock they want out of because it's not worth 100, it's worth 90. They could flood the market and perhaps drive that price down because we're never going to get around the issue of supply and demand. You've flood a marketplace with supply, and then the price is going to go lower. Similarly, flood the marketplace with demand, and the price is going to go higher. You need to find that balance, that equilibrium price. So if they flood the marketplace with supply, that $100 stock may now erode to say $95 a share simply because there's a far greater supply. Dimensional might step in and make an offer to purchase this security from this seller for say $98 a share. I may be slightly oversimplifying, but the concept is exactly what takes place. So they now are a trading partner. How can both sides be satisfied with this particular trade? Both sides go away happy. Well, it's because of this fundamental philosophical difference in whether this $100 price in my example is fair, is correct or incorrect for that matter. Actively managed says, we've done our research, it's not correct. It's really only worth 90. Dimensional says, we're not trying to be smarter than the market. We're going to accept the $100 price. This is how both sides can now be happy in the equation. How? Because the seller now sells this big block of stock, say for $98 a share, when if they had flooded the market with supply, they might have only got $95 a share. So they found this trading partner in Dimensional that's willing to pay that $98 a share. So now they figured, wow, we've made an extra $3 a share for our investors. What a wonderful trade we've just made. Dimensional on the flip side says, what have we done? We've just bought a stock that the market says is worth $100. We just bought it for $98. We just created $2 of value add for the investors in our funds. We accepted the market's price. We didn't pretend to be smarter than the market. We accepted it, but we found a trading partner who was willing to sell it to us for something less than what the market determined. So rinse and repeat over and over and over and over again, and it becomes a very effective way of adding value to the mutual funds that Dimensional has created and manages, without having to have any particular prescience as to where markets are headed or where a particular stock is headed, simply accepting a stock's price at any point in time as fair, and then looking to see if there are trading partners who think otherwise. I guess you could see why I put this in the deeper dive category, because for a lot of people, it's just not going to hold their interest long enough, but it's a really powerful, fundamental point. And I hope in my example, I've kind of explained why I believe in an approach that is not pure index, nor pure active for sure, but it's a hybrid, cherry picking the best ideas and producing bona fide value added for us, the individual investors. Thanks for spending some time watching this, and if you'd like to have any questions or talk about it with me further, I'm more than happy to talk with you. Shoot me a message or an email, give me a call, schedule some time on my calendar, and we can talk about it more. Thanks again, everybody. Be well.